First off, welcome to the update on the new Tax Act, which isn't so new anymore. But I thought I might ask, who in the room was at our January 31 seminar? So actually, probably at least half of the room. But you might remember that one of my concluding comments was we would likely have another seminar this year once we had regulations to tell us what was implied by a couple of the provisions. So I thought it'd be good just to remind everybody, what did that new Tax Act do? So 6 things. This is the first one, the 20% deduction for business owners and rental property owners. And I agree it's complicated, but I was able to find a picture that best describes this provision of the law. So there is my picture, and it's extremely accurate in my opinion. So the problem with the 20% deduction is it treats business owners unequally. So doesn't matter, you could be in the same business, treats different people differently, as you'll see in a minute. So I will tell you that we have taken people who have been sole proprietors and moved them into a corporate way of doing business. We have taken people in a corporate way of doing business and moved them to sole proprietors. So you'll see some of that in just a minute. So here were the other provisions of the Tax Act. So I'm not going to spend much time with them, but tax rates went down for 2 of them. The estate exemption's up, so less people paying estate tax. Big depreciation deductions for businesses and real estate owners, and a big change in itemized deductions. So. But the one thing we didn't cover, if you look at that list, was opportunity zones. And the reason was we had no idea where they were going to be. And lo and behold, downtown Colorado Springs and other parts of Colorado Springs are actually in opportunity zones, and they become much more relevant for us. So here's the quick review of the agenda for today. We're going to spend 45 minutes on the 20% deduction. Then that will include questions. Then we'll take a 2-minute stretch and then talk about opportunity zones for 40 minutes, take questions then. We have beer, wine, cocktails going for the hour after the seminar at 4:30 and hors d'oeuvres next door in the main room. So I hope everybody can stay for at least some part of that. So, and most importantly, if you want to send questions as the speakers are going, just text them to that number. They then get looked at and then passed on to me, which then I'll read them off for the people doing the presentation. So, and I think everybody has a folder. The slides are not in the folder. They're available on our website. But the relevant handouts that the people will be covering as our speakers are in there. So, I think I covered all the initial stuff. So we're going to start with the encore presentation of Section 199A, which is the 20% deduction. And we have Judy Kaltenbacher, who's the partner in charge of our tax practice, as well as Jordan Impey. Jordan's a fellow tax partner, and he's the marketing, he's the partner that oversees our marketing department.
Minutes, and we can keep this up while I have 2 kind of initial thoughts I kind of wanted to share with you. So today I was at the Switchbacks announcement, and the vice presidents were up there and very eloquent speeches about community. I'm like, man, that'd be nice, but I just get really limited material, so you will have to bear with that. It is tax law we're talking about. So, and the other thing, my wife and Eric were talking last week at an event, and she was telling him a story about the first time she met me. She had no idea what I was saying. It took her about a year, so you guys are all screwed too. And we're going to get going with that. So first, a quote to kind of set the stage. Did you get the number? Yeah. So this is from the 1920s, and it's Will Rogers, one of the better tax quoters in the tax world. The only difference between death and taxes is that death doesn't get any worse when Congress meets. And you are going to discover that over the next 40 minutes. We're going to do our best to try to unpack it, but it's rough. So what are we talking about today? With tax reform came a new non-cash 20% business deduction. There are 5 ways that you're going to lose this, but in essence, that's a simple way of looking at it, is you just get a 20% deduction because you own a business. Which types of businesses? Anything besides a C Corp, basically. That includes sole proprietorships, S Corps, partners, trusts, and estates. This was effective as of January 1st. One spoiler alert later for the new rules, they actually said if you're a fiscal year entity that goes backwards into 2017, you're going to qualify on the whole year income. So you'll get some of 17 as well. This is one of my favorite slides. The first row here is for C corporations, which are been in the news a lot with tax reform. And then we'll call this everything else, but we titled it pass through. The middle column is the old law. And don't worry too much about the details, but the total tax for a C corporation, if you pulled all your money out, was around 50%. If you were in a pass through in the old law, it was about 41%, a 10% difference. With the tax cut, when everybody knew about the C corps, they're going to get this flat 21% rate. You still got to take money out of the corporation, typically. So it's not exactly that. It's about 40% now, so it's a lot less. And if you qualify for this new 20% deduction in full, your rate's only going to be about 30%. So magic, 10% difference. So we're in parity. The only comment I'll make here is I do think C corporations with having a flat rate for everybody is a lot simpler. We have key limitations. And so everybody has one of these in your handout. We're going to be kind of walking through it. I do want to first thank Melody and the marketing department for spending hours and hours on this because we tried to boil it down to just plain English, and that was nearly impossible. But big picture takeaways for everybody is all the stuff we're going to talk about for the next 30 minutes may not be as relevant to your situation. So in this key part right here, you just want to say, am I married, and do I make more than $315,000? Or if I'm any other filing status, it's $157,000, so no marriage penalty. That's a key takeaway. It becomes much simpler if you're in this box. There's 2 things you kind of have to look at, but the rest of it's easy. If you're above that, that's where the quote comes into play.
All right. So we're going to start at the beginning. Brand new deduction starting in 2018. New guidance that we just received in August. Your accountant's experience, that will be us, it will be key. And we have spent hours and hours, even before our presentation in January since then, looking at the cases out there, information, articles, everything to try and help us figure out how to apply this for all the different scenarios. QBI, in a nutshell, is your net income losses from a qualified trade or business. Easy enough. So where do we look to find that income? It's going to be from your Schedule C, K1s, from partnerships and S corporations, and your Schedule E rental properties. What does not qualify? That's pretty easy too. Mainly your investment income, interest, dividends, short-term, long-term capital gains, W-2s as an employee, and any reasonable compensation, wages, guaranteed payments from S Corp or partnerships. Let's talk for a minute about QBIs and rental properties, because this is a big one for a lot of people. We as practitioners were really hoping to find a lot of good guidance when they put out the proposed regulations. Unfortunately, that didn't happen. And if you look at the quote at the bottom of here, this is the chief counsel for the IRS. It's only been 100 years or so, and we still don't have a definition of a trade or business. Well, guess what? We still don't have a good definition of a trade or business. It didn't come out with these regs either. So, in fact, what the regs said was that every business must separately establish that it rises to the level of a trade or business. So what does that mean? In terms of rental properties, we know that the rental properties were meant to qualify. That was pretty clear in the law. But which rental properties? And what counts as a qualified trade or business? The interesting part was that there was no carve-out for real estate professionals, and this was really surprising to us. So what it meant that, people who live their trade in the rental real estate world still have to establish that their rental activity rises to the level of a trade or business and follow these nebulous rules. We're really hoping that something comes out with a better definition in the final regs, some kind of a safe harbor. That's what we were expecting to see, and we didn't. But Plus for taxpayers was the self-rentals. And what the proposed regs say is that self-rentals are considered to be a trade or business. And what this is if I have a property, whether it's individually or in a partnership, and I lease it to a commonly controlled business. So let's say I have a business over here, whether it could be manufacturing, it could be an auto dealership, and I have my building over in a separate entity, but I lease it to that trade or business, that is automatically considered a trade or business. The rental part is. So that was good news. Good news. One for taxpayers. So where do we go from here? Well, in the absence of guidance, we turn to case law. And the case law has defined rising to the level of a trade or business as an activity that has continuity and regularity and a profit motive. And the courts have based their decisions on several factors, such as the day-to-day involvement of the owner, or the type of rental property. Is it commercial or residential or personal property? How many properties there are being rented, and the type of lease, whether it's a triple net lease or a traditional lease, a short-term or a long-term lease. So we're going to look at a few of these cases. And I would say that you're going to see practitioners have to really dig back into these cases. And I want you to pay attention to the dates on these cases, because it's interesting how old these cases are that we're looking back to, but that is what's out there, which is for us to follow. So, and it's up to us to dig into those cases and find those facts and circumstances that we can make sure that you, as our clients, can figure out whether or not you have to change your lease or change how something is structured so that your rental activity can qualify as a trade or business. So the first one is Guilford. This was the rental of multiple properties in which the owner was not hands-on, and it was deemed to be a trade or business. The court focused on the amount of work required by the management agent. If such management was a trade or business, then the taxpayer so engaged, although acting through a trade or the agent, was considered to be a trade or business. And this is huge because there was a worry about whether or not using someone to do the management for you would preclude you from being considered it to be your trade or business. So that was a 1 thumbs up, yay. Better news, so 2 thumbs up, was Fackler. And this was a rental of a single family commercial building. And it was deemed to be a trade or business. What the courts determined was that the owner of depreciable property devotes to rental purposes exclusive to the production of taxable income, there's our profit motive, was deemed to be a trade or business. Okay, next one, 3 thumbs up. Jordan, I need another thumb.
I have a different finger for making me read all these cases.
As long as it's pointed at the lawmakers and not me.
Yep.
Okay, so this is really important. And there are several cases for this one. Again, look, old cases, but what they determined was that a single family residence was deemed to be a trade or business. And what the courts said was that they've repeatedly held that renting of improved real estate constitute carrying on of a trade or business, regardless of whether the taxpayer is involved in another trade or business. So you could have a completely different job and have a rental property on the side, and that still be considered a trade or business.
All righty. So someone here in real estate, tell me the #1 most important thing. Thank you. Same thing with these tax cases. Similar fact patterns in different appeal courts. So there's the court system is the same in the tax world. Same facts, different results. So unfortunately, I think District 2 is not as favorable towards trade or business status for rentals where District 10 is. Again, we're just digging because we don't want to leave you just hanging again. We did get some, just as a backstory, with the net investment income tax that came out in 2013, a tax on your investment income. The proposed regs, which is what we're working off of now, didn't mention anything about real estate professionals, but the final ones did. So if that's true, then hopefully we don't have to worry too much about this. But in the meantime, we are. This case from 1938, this person didn't even rent the building. They just attempted to rent the building, and it was considered a trade or business. So another good factor. One that's actually not good, and if you have this fact pattern, there's actually is some guidance out here that this is a negative fact pattern. So a triple net lease, for some reason the court in that regard didn't think that you were performing enough services to rise to that level, Although I would say a lot of commercial buildings where the property manager is super involved and the owner is, it's hard to say that they aren't, but that is something to consider if that's your situation. That was actually ruled not to be a trader business. All right, so we're going to leave the rental side alone, and we're going to move into kind of the overall deduction. So set that aside. Remember what I said about the simple side. If you're under 315 for married or 157 for anybody else, don't worry so much about this. The first two you need to, but the rest are going to apply after that other level. So this is one of our favorite authors, Tony Nitty, and his quote's perfectly accurate for what we're about to do. The new section 199A, however, is anything but simple, and the 20% deduction is far from guaranteed to business owners. Claiming the new deduction requires navigating a tangle of limitations, terms of art, thresholds, and phase-ins and phase-outs. Just a warning, Judy and I didn't create this. We never would have, but you're going to have to deal with it. So in the chart you have, we're going to focus on the right side, and that's, again, if you made more than 315 and 157. I'm going to say it so many times today, you're going to be sick of it, but you're going to remember it. So here, we kind of came up with, these are the big 5 limitations. These are the things that will take that 20% that's given to you away. The first 2 that I'm going to cover apply to everybody. So if you make $10,000, still applies. The last 3 are the magic numbers, 315, 157. So taxable income, what it works here is if I have a business that generates a 20% QBI deduction, that's great, but if my taxable income is a lot lower, you have to look at 20% of that. And we'll walk through an example of that, but this is kind of a catch-all that you're not going to reduce your overall rate if you have a lot of probably itemized deductions or something else that reduces your income. Just as a side note, through the whole tax reform bill, these numbers are kind of what I call the new rich. Every law has kind of their key points. It's the same numbers that I've been mentioning, but even if you look at the individual rates, I think like in the married, the 24% rate ends exactly at 315. So this is where they decided to make it difficult. And why is that important? Well, you're going to see where you could lose your deduction if you don't do proper planning. So here's a quick example. We have Sam. Sam has a business that generates $600,000. We can all do this simple math. He tentatively gets a QBI deduction, this new deduction of $120,000. But what if Sam made a very, very large charitable contribution in this year? And so his actual taxable income for the year was only $157,000. So this example is just trying to highlight that in kind of a simple fashion. You walk through his income. He basically is entitled to a $120,000 deduction. But because his taxable income is $150,000, you can only take 20% of that. So $30,000, we're limited to the lesser. Nothing too crazy, but it is something just to pay attention to if you're doing some planning. The next one that affects everybody, again, this applies to anybody, is the capital gain limitation. And this one has some logic. Capital gains have rates of 0, 15, and 20%. So they're already preferential rates compared to ordinary income. And if you were able to take a 20% deduction on your business and pay capital gain rates, you could actually potentially get lower than the capital gain rates. So no double dipping. If you have a large capital gain, if that's the only tax you're paying for the year, you're not going to get any of the QBI deduction. It will be eliminated. Just something to prepare your mind that applies to everyone.
Okay, we're going to talk next about the specified service trader business, and that's the only time I'm going to say that. Now it's going to be SSTB. So this is a big thumbs down, especially for yours truly, accountants, attorneys. But remember what I said before about needing to rely on your accountants. This whole law, and think about Eric's maze. If this, then that. Otherwise, that. Oh, but by the way, there's this limitation over here that may apply to you, and there's one back here that may apply to you, and there's one over there that may apply to you. So we have to keep track of all of those limitations. So getting back to that definition of qualified trader business, it's any trader business other than this SSTB, or the trader business of performing services as an employee, which I already went through. You can't use your W-2 wages. And this SSTB is that we're into about the middle of your flow chart. So this is basically all of the industries that are considered to be SSTBs. Like I said, accounting, boo. Law, health, financial services, consulting, brokerage services, athletics. And then this catch-all definition, which is pretty interesting. Trade or business where the principal asset of such trade or business is the reputation or skill of one or more of its employees. We were really worried about that definition when it came out in the law. Thank goodness the proposed regulations clarified it and took a very narrow interpretation of it, and such that what they're referring to is that if you, kind of basically if you're famous, if you get fees for endorsing a product or service, then it qualifies as an SSTB. If you get fees for using your name or trademark, same thing, it's considered an SSTB. So very narrow interpretation, which is good for taxpayers. So I guess that's +2 for taxpayers now. These are all the groups that are industries that are not SSTBs. So this was what was carved out. Real estate brokers, property managers, architects, engineers, health clubs, health spas, banking, insurance, right? All of that. And the other thing about the SSTBs is I would say this is a big piece of the new law that the proposed regulations spent a lot of time defining and explaining and showing, providing examples and things like that. So in your handout, okay, not actual handout, it'll be online. At the back of the slides, there's kind of an appendix, and we have some examples in there. For instance, defining health law, SSTBs included doctors, nurses, veterinarians, all of that group who actually provided services to patients. So not included in that group would have been your health clubs, health spas, personal trainers. And there are some question marks out there, like what about a radiologist who doesn't provide services directly to patients, but just reads x-rays? We don't know for sure yet. So this is that part of your handout. Again, the if this, then that, then yeah. So after you get through your income question, then you ask yourself, am I an SSTB? If you are, yes, then you have to ask another question. Is my income more than $415,000 if I'm married filing jointly, or $207,500 for all other filers? If that answer is it's more, then you're done. You're not eligible. You don't get to take any deduction at all. If it's less, so you're between $315,000 and $415,000 for married filing jointly, then you may get a partial deduction. So we're going to do an example. Meet Jane. Jane is she's a partner in a law firm. She's married and has taxable income of $800,000. Okay, right away, red flag, red flag. She's an SSTB and her income is way over $415,000. So I can tell you right now, she's not going to get the deduction. I don't care what the income is from the law firm, and I don't care what her wages are. She's not going to get the deduction. But, okay, so 2, she's still an attorney, still married, but her taxable income is only $300,000. So, and her share of the law firm income is $200,000. Her W-2 wages are $60,000. She is now entitled to the deduction because her taxable income is less than $315,000. So she gets to take a deduction of $40,000, which is 20% of this $200,000. We don't care what her wages are. She's under the $315,000. Now, if her income was between $315,000 and $415,000, then we would care what those wages are being passed out to her. Then she might get a partial deduction. So here's the big summary, right? If a business is mentioned on that SSTB list, then you can get the 20% deduction if your income is below this $315,000 or $157,500. If it's over the $315,000 but under the $415,000, then you may get a partial deduction. If it's over the $415,000 or $207,500, no deduction at all. Now, a couple of other things that were clarified in the proposed regulations. There's a de minimis rule in there. So if you have a trade or business and you have a small sliver where you might do an SSTB type of a function, and I'll give you the numbers in a minute, but you don't have to pull that out. You can just take your whole income and take that times the 20% deduction if you qualify. So what it is that if your company has gross receipts under $25 million and you have de minimis amount of gross receipts of less than 10%, then you don't have to pull it out. If it's over that amount, then you do have to pull it out, and you only get to take the 20% deduction on the amount that's not the SSTB. For instance, if I have a company and I sell computers, okay, so 95% of my gross receipts is from the sale of the computers, but I do have this little operation side, installing, consulting, that kind of stuff. That's considered SSTB, but it's under the 10% limitation, so I don't have to worry about pulling it out. But if it was 85 and 15, then that would be a problem, and I would have to pull that consulting income out and not get the deduction on it. The other thing that the IRS was cracking down on was cracking rules. And what this was is those SSTBs, those creative ones like accountants, just kidding, attorneys, when the law first came out, they were trying to carve off some income that would otherwise not be considered income from, say, their accounting worker, attorney, or whatever, and pull that out into a separate entity. And say, put a building into a separate entity and lease it back to the company, kind of like the self-rental, what I was talking about a few minutes ago. Well, the lawmakers came out and said, yeah, no, I'm not doing that. You don't get to do that, which was called the cracking. So, and there are some limitations around that. There has to be common control, and it has to be over 80% of business use or renting, I'll say, to the trade or business. So there are a few ways around it if you can be creative enough and you're willing to give up some control of your company. So that was a pretty big one. Those two were things that there was a lot of clarification in the proposed regs. All right, more if this than that.
Yeah, so I don't know, sometimes I think, like, how the heck did Congress sit around? I don't know how you come up with this, but they did, so we're talking about it. This is the example, I think, where you have entity inequality, and I'll just kind of briefly say you have a company that just say they make $500,000. If I'm a Schedule C sole proprietor and I have no employees, you can't pay yourself in that situation, so you have zero wages, so you get zero deduction, and because your income's above that $315. If you're an S corporation, you are required to pay yourself wages. That's part of the law. And those wages count towards this W-2 limitation. So you would get some of the deduction based on paying yourself, even with no employees. If you're a partnership, no employees, you can't pay yourself a salary either. So you can see where they didn't really make it quite equal for entity types, because certain types will need to actually change their form to qualify. Again, remember this applies over the magic numbers, 315 and 157. And they came out with a lot of guidance on how to figure out the W-2, how you allocate it. Don't worry too much about it. It's basically off the W-2s, the W-3. If you're in an S corporation or a partnership, in an S corporation, you'll just get allocated your share of ownership. Pretty straightforward, simple. In a partnership, which has all sorts of funky allocations, how they allocate the wage expense is how you're going to get allocated your share of the company's W-2s. So again, just something to remember. Once you reach those thresholds, you lose the deduction if you don't have enough wages. So let's just kind of make it a little bit clear, if we can, with kind of multiple limitations we've talked about so far. So back to my original example, we have Sam. He has the same business, $600,000. He is not an SSTB like Judy just talked about, so we don't have to worry about that mess. And his share of W-2 income is $44,000. So that's all he has. His taxable income for the year, if you guys remember back to the first example, was $150,000. And so I just kind of want to walk you through the math. We take 20% of the first one. That's a potential what we could get if we had the full thing. 50% of your W-2s is only $22,000. And then you have the taxable income limitation that's always there, just to throw it in as an example. But guess what? You're stuck with the least amount. So he's only going to get a deduction for $22,000. Now, if he paid himself just a little bit more, he'd at least get the $30,000. And if his income was the full way, if he paid himself a lot more, he could get the $120,000. I ran an example today, and if you're kind of over the Medicare top amount, you're only paying 2.9% of self-employment tax. This can make a big difference. I did a $60,000 wage change, and it was about an $8,000 savings. So this is where planning becomes key, even if they made it terrible to explain.
Okay, this is the second half of the W-2 limitation. When the law was first issued, I would say before it was final, there was the W-2 limitation. But for all the rental properties out there that typically don't pay W-2 wages, they pay a management fee to a management company, they weren't getting this deduction. So Congress said, okay, we got to fix that. So again, we've already been through all this, right? It's the QBI deduction is the lesser of 20% of your QBI, the greater of 50% of W-2 wages, which Jordan just went over, and then they added this, or 25% of wages plus 2.5% of your unadjusted basis of qualified property immediately after acquisition, which, remember that UBIA. Okay, unadjusted basis just means it's your basis before you depreciate it. And qualified property, any tangible property subject to depreciation held by the business at the end of the year, used in the production of QBI. It's a little more complicated than that, but we're not going to get into that today. But this is a good example to explain it. So Pam owns a 50% interest in commercial rental properties through an LLC. Her share of the rental income from the LLC is $1.5 million. The LLC pays no W-2 wages because it pays a management fee to an S corporation that Pam controls. The management company pays W-2 wages, but it also breaks even, so it doesn't pass any net income out to Pam. Pam's share of the total unadjusted basis of the commercial property is $10 million. So she's entitled to a deduction of $250,000, and here's how you get there. Again, assuming the rental rises to the level of a trade or business. Oh, you just have to hate that after this much, huh? So it's equal to the lesser of 1 or 2, so 20% of the $1.5 million of the income from the rental, which is $300,000, or the greater of 50% of W-2 wages, 0, or 25% of W-2 wages, which was 0, plus 2.5% of the UBIA, which was $10 million. So that's where you get the $250,000. So you can see, before they put this in here, the deduction would have been 0, because it would have been limited to 0 by the W-2 wage limitation. So that was another plus for taxpayers. All right, our summary now. For income above certain thresholds, limitations may apply. All QBI calculated will be combined and reported on the Form 1040. However, and here's the hard part, all at the business level, your partnerships, your S corporations have to take all this information and accumulate it and pass it out to your partners or shareholders through the K-1s. QBI income and losses are netted at the individual level. But here's the bummer. The net QBI losses that you may have in any one year, they don't just go away. They get carried forward to the next year, so that if you have QBI income in the next year, it gets reduced by those losses that you had gotten from the year before. Applies only for income tax purposes and determined without regard to alternative minimum tax.
All right, so the new rules that came out in August, and just to give us a quick overview, proposed regulations are, I think you call it's your college try. It's the first attempt by the IRS to put out the rules. We may rely on these. We don't have to rely on them, but we may is the actual wording in this regs for 199A. And what that usually has is a time period where people can comment on what they provided, and then the IRS can adjust it. So what comes out later is the final regulations. So we're dealing with the proposed regulations that came out in August. No timeline on when final would come out. The first item, this is one that I think was, at least in my opinion, was the most unfavorable to taxpayers. And a little bit of, none of the other laws went away, by the way, for businesses. We still have all the other things to deal with. But Section 1231 is, in essence, when a business sells an asset at a gain or a loss, there's a special rule where you kind of add them all up down to the 1040 level, the individual level. And if you have a positive, it's a capital gain, so those preferential rates. And if it's a negative, you have an ordinary loss, so it's an ordinary loss. So it's kind of a win-win for a taxpayer, although in regards to QBI, it's a loss-loss. And I'll explain why. It's, the term is kind of a whipsaw. There you go, take that one home. You lose on both sides. And if you have a 1231 gain, capital gain, even though it's from a business, does not count in this whole QBI world. And it also eliminates part of the deduction because it's a capital gain. So it's that second limitation I talked about. If you have a 1231 loss, an ordinary loss, they reverse their ID and say it is a QBI item. So it actually reduces any of your other business income. So lose-lose. Hopefully they'll get enough comments and change that, but it's something to consider. The next thing is trader business groupings. We've already have a couple established grouping mechanisms out there. They created a brand new one, so that's fun. You get to learn something new again. And the reason why you need to pay attention to this is, let's say one company has all the wages of all your employees, and it kind of breaks even. And then you have another company, because it has no wages, has quite a big loss. If you did the QBI applications on each, you might end up with 0. But if you're able to group, you could actually pull the wages into the profitable one, and at least you have wages to qualify. Again, remember, it only applies at those income levels, but we do have guidance on that. I mentioned at the very beginning the fiscal year businesses. So if your year end is April 30th, 17, you actually get to take all the 17 income and a little bit of 18 and apply this law. So you don't have to just count January on. QBI deduction does not reduce your tax basis. So if you own a partnership or an S corporation, this actually doesn't reduce that. And you actually would have less, you'd have more basis on a sale. So it's a good thing. A few things in the world of SSTBs, and I won't talk too much about it because Judy already did. We have de minimis rules on if you qualify as an SSTB or not. We have the catch-all, which I think was actually the most taxpayer-friendly. If you think about what they could have done with this, they said anybody's reputation in their business could actually make you an SSTB. So because a lot of people know Eric, we could be an we already are, but if you're in any other industry, you would be an SSTB. So that one could have been really bad. It worked out well, just celebrity status. W-2s for the testing, you do get to add back all of your employees' deferrals. So if they're participating in a 401k plan, you get to add that back. People were worried about if they use PEOs. If you don't know what it is, don't worry about it. But if you do use one, those do count as long as they're your employees. So that's a big win for a lot of people. Asset tests, if you're in a like-kind exchange, they provided some guidance on how you look at those asset testing that Judy went through. What don't we know after the regs? Well, rental real estate, which we've spent a lot of time on. How does this interact with self-employment tax? We do know that it won't reduce the self-employment tax, that 20% deduction does not. But there's still some guidance out there. I think a planning strategy is potentially unreimbursed partner expenses until they actually say that. All those are is if I'm in a partnership and I pay for something out of my own pocket, through your tax return you can actually still deduct that. You're just not deducting it through the partnership. Right now, it doesn't mention that in the QBI deduction, so could you double dip? Maybe. That's yours.
I was just told we only have 2 minutes left, so I'm going to do this really fast. Bunch of thumbs down. You all could just sit out there with your thumbs down because of all the additional reporting. So we're just gonna apologize right here and now because we're going to be bugging you in busy season to get all your information, and we're going to ask you more questions than we've ever asked you before because of what we have to pass out on the K-1s. And the problem is that we don't know what's happening at the 1040 level, at the individual taxpayer level. So that's the reason why Congress put this in there, that it doesn't matter whether or not, even if I know that the 1040 doesn't need this information that I have to pass through, I still have to pass it through. So, and this is the worst one right here. Failure to disclose means the owner's share is presumed to be 0, which means any deduction you might have gotten of that 20%, you won't get unless it's passed through to you through your business. Let's see, what's my favorite one on here? Expect delays from the IRS during filing season, possibly resulting in more extensions. I hate to say that, but I think that's the reality. The IRS has already come out and said that they're going to be late in issuing the forms. So we're going to do our best. And there are some things, some big items out there that still need to be clarified that we don't have clarification on yet. So we're going to have to wait for that as well before we'll be able to actually submit tax returns. So, okay, Eric. Are we good? We're good on time.
We have questions flowing in.
Oh, okay.
Okay, first one. Is there an opportunity to use the charitable deduction to gift property subject to capital gains or the enterprise-owned capital gain deferral to carve out capital gains to meet the threshold to qualify for the QBI?
Yeah, absolutely. Charitable would be an itemized deduction, which is before taxable income. So you could get there by actually dropping it down. And if you go back to the one slide with year-end planning strategies, go back one. So this one actually here of like managing taxable income, that includes a lot of things with year-end planning, retirement plan contributions. The whole point of that is to get below the threshold if you're close enough, so therefore you don't have to worry about the mess. But yes, I think if in substance that was the question.
Yes, all right. Good answer. Okay, for opportunity zone investments, I'm going to save this one for the next session.
Thank you.
Okay. Are assisted living, home care, and non-emergency medical transportation SSTBs, specified trade or business?
Please see the appendix. Unless you know.
So say that again?
Yeah, are assisted living, home care, non-emergency medical transportation SSTBs?
I
think it says direct
I think-
service
Yeah, it
to
says direct
patients
service
is
I
an
think the answer
SSTB.
is no.
is no, yeah.
I think the
but-
answer is no.
Yeah.
Yeah, so, okay. Okay, how, if at all, is the 20% pass-through business deduction likely to, one, influence opportunity zone fund investment, and two, impact donations to charities?
Well, on the first one, I don't think we know yet if an opportunity zone will qualify as well, but it probably will. I don't think there is guidance on that. And number two, in charities, that might be in regards to funding for charities, which is a big concern. I think that has to do with like the individual, like itemized, or the standard deduction doubling. So I don't think this interplays quite as well.
Well, I'll throw it, if my taxable income was 400, I'll just say 400,000, I wanted to get it down to 315.
Sure.
I could do more donations to get more of the 20%.
Yeah.
Oh, okay. The W-2 limitation, is that on W-2 income paid to me by the business or paid to anyone by the business?
Anyone?
Yeah, all
It's
of it.
you don't get the entire company, you get your share. So if you're an S Corp, it's how much you own of the S Corp. So if you own 100%, it would be all of it. If you own 50, it'd be half.
So that's why we're going to be asking you for your W-3 information so we can provide that through all of the K-1s.
Okay, architecture firm, sub-S Corp, 20,000 profit, pays $80,000 W-2 income. Taxable income is less than the threshold. Okay, I'm not sure what the question is, let's see. Yes, and I think maybe that's just the answer. If your taxable income's under 315,000,
Then you get the deduction.
sure.
So whatever the QBI income coming through to you is, you get that 20% deduction.
And architects were carved out,
Yeah.
so they actually they're not an SSTB as well.
Okay, so even if they had 500,000 of income, as long as they had some wages.
Yeah, at 315,
Yeah.
you got to start looking at wages, those
Okay.
magic numbers.
If a rental is a trade or business, does the owner owe self-employment tax on the income?
No.
No.
It's always been the benefit of rental real estate, yes. Okay, what tax planning strategies could we use for 2018?
All of them and more. I mean, I think one thing that we have with tax reform now that we've done it before is large purchases of equipment. With the tax reform now, you actually used equipment qualifies for bonus, and bonus is 100%. So whatever you pay for it, it's immediate write-off in that year. So even if you were at 415 and you bought a $101,000 piece of equipment, you're automatically below. Again, your business comes first, not tax, but there is a lot of easier ways to manage income.
So your slide's a little relevant right there.
We're just leaving it up there.
Retirement plans, yeah. Okay, in simple terms, if you increase
Really?
wages.
Really? Okay, sorry.
Yeah. You know what they say about the pure and simple truth? You know, it's rarely pure and seldom simple, yeah. In simple terms, if you increase wages and pay 16% payroll tax, but save on the 20% deduction, would this be advantageous?
So that one's a little bit more nuanced. My example, what I talked about that was just the 2.9%. So that means you were already over the cap on the wages that you have to pay the full 15%. I haven't done the math on that part yet, but I do know that if you're above the cap already, it's absolutely advantageous. not positive on the numbers on the self-employment
It's one of
side
those
them.
it depends answers, and I think that that's going to be a lot of what we see going forward with tax planning. Everybody's situation is going to be different, and so we're going to have to look at each situation to see what makes sense.
Right, but I think somebody hit it pretty well. If you have to create a 15.3% payroll tax to save 20%, you still win, but not by
By
a lot.
much,
lot.
yeah. It's
Yeah, although payroll tax, I mean, means you're paying more salaries, you're getting more social security, for yourself in the long run. So, okay, what do you like least and best out of these proposed regulations? Just summarize again. What do you like least and the most?
I would say I like least that there wasn't enough guidance that I was hoping to see with regards to rental properties. What I liked best was that there was a lot more guidance around SSTBs and a lot more definition, because I think there were a bunch of big question marks as to exactly who fell into an SSTB and who did not. Jordan?
Least would be 1231 issues. We kind of went over a little bit. I think that's.
What do you mean by that?
So 1231, if you have a gain, it's not going to qualify. If you have a loss, it will qualify. So it hurts you on both sides. And the best one for me was the catch-all, because I think that could have been just terrible for everybody. They could have said, you have to look at how much the owner is involved in the business and like who isn't in that person.
So what do you think you guys will be doing for the rest of the year?
We hope all you guys will be calling us for tax planning. Lots. And setting up, we have to calculate the asset testing. How are we going to gather that information and pass it through the businesses? So we'll be busy.
So that's the end of our question, but just one last. So is this real money that we're talking about on this?
Yeah, absolutely. If you go back to that earlier slide, if you're in the higher brackets, that's 37%, 29.6. So it's definitely real money, and it's worth the time.
So we have one client whose taxable income is $12 million as an S corp. 20% of 12 million is 2.4 million. 40% tax rate on 2.4 million. Whoa, that's like 960 grand.
He's the only one in the room that could do it that
Yeah,
fast.
in your pocket after cash. Yeah.
Right? Yeah. It's
Yeah.
definitely real money.
Yeah.
You just have to own a business.
Yeah. Did you guys ever hear what Joan Rivers had to say about money?
No, tell us.
Jordan, do you know who Joan Rivers
Yes,
is?
but not really. She's that lady on like E! News when they have the red carpet, right?
Yeah. Her comment was, people say that money is not the key to happiness. But I figured if you had enough money, you can get a key made. All right, so we're going to take, thank you guys, by the way. Thanks, Judy and Jordan. So I think rather than just sit for an hour and a half, if we could just take 2 minutes to just stand and stretch, and then we're going to take on the opportunity. It reminded me, since I was on the plane, of the guy Aaron, who won like Jeopardy, 15 episodes, in a row. So it made lots of money. So he gets on the plane, he upgrades himself to first class, and he sits down next to this older gentleman. He's probably 90 years old, and all this gentleman wants to do is take a nap. So the Jeopardy guy's all pumped up, and he says, I've got this fun game. So I asked you a question, and if you get it wrong, you owe me $5. Then you ask me a question, and if I get it wrong, I pay you $500. So the elder gentleman next to him says, I really want to get to sleep, but yeah, I'll play the game. So the Jeopardy winner says, what's the distance from the Earth to the moon? And the older gentleman, he has his $5 out of his wallet in 5 seconds. He just hands it over. He doesn't know. So the Jeopardy guy's all excited, and he says, all right, your turn to give me a question. So the elder gentleman says, what goes up a hill with 3 legs and comes down with 4? So then the elder gentleman goes off to sleep. So the Jeopardy guy, he's got his laptop with him. This guy's asleep. So he's Googling the question. He's emailing all his friends. And as the plane's coming down, he wakes the elder guy up. He says, I don't know. Here's the $500. So Well, the gentleman puts it in his pocket, he gets back to sleep. So as they're coming up to the gate, it just, the Jeopardy guy just fit to be tied. So he wakes the elder guy up again, and he says, "What goes up the hill with 3 legs and comes down with 4?" And in 5 seconds, the elder guy has his wallet out, he pays the $5 and says, "Heck if I know." But anyway, the relevancy or the moral of this story is not all questions have absolute answers. And in the law that we deal with tax, and especially with new act provisions, because there's no court cases, we're lucky to have some proposed regulations. Most tax questions are usually answered in the rule of Pung, which is probably, usually, normally, and generally. And that's kind of what we're dealing with, and you can kind of see that with Jordan and Judy's presentation. So we'll see how relevant it is for you guys. So for Opportunity Zones, Trinity Bradley Anderson is our managing partner, a fellow tax partner. Jarrett Ustray is a senior tax consultant. So Jarrett has both the willingness and distinction, as far as I know, to be the youngest person to ever present at one of our client seminars. All right.
Thanks everybody for coming and joining us. I'm going to add one more word to what Eric said, maybe. I'm using a lot of maybe, it depends, reasonable people. Rampant rumor and speculation comes into play sometimes with this. So to talk a little bit about the opportunity zones, what Eric mentioned, when this was kind of snuck into the Tax Reform Act, and we were not paying attention to it. It was not even a topic of discussion at our seminar in January and had really no relevance to us until I got a call sometime in about, I think, end of February, middle of March-ish, from one of our clients whose property was being considered to be put into the opportunity zone. And he's like, "Trinity, what is this?" I'm like, "I don't know." So had to do some quick research to figure out why it was relevant, who it would matter to. And that was kind of the beginning of paying attention to opportunity zones. And it became a lot more relevant when the opportunity zones were actually designated. So Jared is going to talk to us about some of those facts and kind of lay out to us how they work.
Thanks, Trinity. So let's cover the basics of opportunity zones. Opportunity zones are a new tax incentive that were kind of buried in with the Tax Cuts and Jobs Act. I think most of the focus was really around the QBI deduction, and this just kind of flew under the radar until people started noticing it. Opportunity zones are designed to spur long-term investment in low-income communities defined by census tract boundaries. We do want to make the distinction that opportunity zones are federal tax incentives, and they're a completely different program than Colorado enterprise zones. Those are state income tax credits. You can use one in conjunction with the other, but we do want to make the distinction that they are 2 separate programs.
Oops, so keep going the wrong direction.
Here we have a map right here that just shows the difference between prosperous and distressed communities across the nation. 1 in 6 Americans lives in a distressed community, and you can kind of see that it is a good mix between both rural and urban communities. And right here, we're going to kind of break it down into what it means to our community. There's 126 opportunity zones in Colorado, with 8 of those opportunity zones lying in El Paso County. As you can see on this map right here, all 8 of those opportunity zones in El Paso County are in the Colorado Springs area. They are all spread out throughout the city, and they're laying on major north, south, east, west thoroughfares such as Platte Avenue, Nevada Avenue, Highway 24, and Powers Boulevard.
And there are actually maps where we can go online with a physical address and type in the address and determine whether or not that address fits within an opportunity zone.
That is correct. Okay, so how and why did they choose these zones? Local government got together with local economic development groups and used different metrics such as poverty rates, family median income, and to determine which of these tracts would best benefit from being designated as an opportunity zone. These zones are certified and they're locked in place for 10 years. That means that unfortunately, if you are investing in property on the other side of the street of one of these zones, you won't reap any direct benefit of investing in an opportunity zone, but you will reap some of the indirect benefits of your community flourishing as a result of this opportunity zone. So why do we care about opportunity zones? What does this mean for everybody? Here are the 3 wins when you invest in opportunity zones. So first, you have to recognize a capital gain event in order for any of this to even matter. The first one would be defer paying tax on that capital gain event. The second win would be reducing the tax that you would owe on that capital gain event. And then the third win, and this is the one that everybody's been talking about, you eliminate tax on the new capital gain event or capital gain earned from your opportunity zone investment. So let's kind of take this into like kind of an example, a very high level example to see how this kind of plays out over the years. So say you have a capital gain event, you recognize 1 million capital gain, 20% rate, that would incur you $200,000 worth of tax. If you were to take that and invest that $1 million gain and invest it into an opportunity zone within 180 days, you would be able to elect to defer paying that $200,000 worth of tax. The latest date that you would have to recognize that tax would be December 31st, 2026. So now let's move on to the second win. So once you have invested that $1 million gain into an opportunity zone, your waiting period begins to qualify for that second win, which is reducing the tax that you owe on that first gain. After 5 years of holding your investment in an opportunity zone, you're going to receive a 10% reduction in the amount of tax that you would owe on that original capital gain. You'll also see that you're going to receive a step up in your investment in the qualified opportunity fund. You're going to see a step up in your investment of $100,000. If you hold this investment for 7 years, you're going to see an additional 5% reduction in the capital gain tax that you owe and an additional step up in basis. So in total, if you didn't elect to defer your capital gain and you didn't take that $1 million gain and invest it into an opportunity zone, you would have been paying $200,000 worth of tax on that gain. But if you were to hold your investment in for 7+ years into an opportunity zone, you would end up paying $170,000 as opposed to $200,000 worth of tax on that capital gain event. So right here, we can just kind of summarize and see, as the years go on, depending on when you were to hold on to your investment for, the unrealized tax savings based off of your investment. Okay, so now moving on to win 3. Same facts as before, $1 million gain realized, you elect to defer, that would have been $200,000 worth of tax. You take that, you invest in the opportunity fund. So now your investment in the fund itself, that holding period begins. Your basis is 0, you hold it for 5 years. At the same time that you receive that 10% reduction in tax on your capital gain event, you're going to see that 10% step up in basis. And then for 7 years, you're going to see that additional 5% step up in basis. Now, here's the kicker. If you hold on to this investment for over 10 years, you're going to completely eliminate any tax on the new gain earned from investing into an opportunity zone.
So the discussion about basis becomes important. Typically when you think about, and you paid $1 million to buy something, you automatically have basis in that thing that you have bought, if it's a partnership interest or stock in a company. However, in this instance, you have deferred your gain. You have not recognized the gain on $1 million. So you have no tax basis in it. So that becomes an interesting question about what do you use to take losses? Because if you have a partnership and you have no basis, how do you take losses? Now, we are focusing this discussion on an equity investment. The equity investment is allowed to use leverage. So you can infuse capital, buying your capital account or buying stock, and then turn around and get loans to complete a build or line of credit or something like that. So typically, that leverage will give you basis, but it becomes an interesting question as to how does basis get realized within, especially the partnership or S-corp realm. So you'll notice that there's a concurrent step up in basis as there's a reduction or a deferral of the gains. So you end up, after 5 years, you have $100,000 of basis. After 7 years, you have $150,000. After 10 years, you have $1 million of basis. That was the amount of money that you originally put in. So I'll talk a little bit about the proposed regs. I'm kind of living a lot in Jordan and Judy's world, and I got these regs about a week and a half ago. So this is a little bit new. So one of the things that we had been hoping was that they would give us the win without a capital gain deferral. So that even if you had fresh money, new money that was not attached to a capital gain deferral, you would be able to invest in an opportunity zone and be able to eliminate the tax on the appreciation. That is not possible. You have to have a capital gain deferral in order to get the 3 wins. It's not possible without it. Capital gains, they did clarify what that is. And so it's anything that's considered a gain that will go on Schedule D. So long-term capital gains, that includes 1231 gains, so the sale of real property, that's considered 1231. Even though your depreciation recapture on real property is taxed at a different rate, it still ends up going to Schedule D. And so our thought is that all of the gain from that would be eligible for the deferral. Again, gains from collectibles, they're taxed at 28% rather than 20%. Those gains would still be eligible for the deferral. Even short-term capital gains are eligible. So they end up on the Schedule D. And so even though you have a short-term capital gain that would be taxed at ordinary rates, it is still eligible for the deferral. Now, when you recognize that gain in 2026, if you've held that long, the recognition, you'll recognize it in the same character as what you deferred. So if you had a 28% gain, you will pay tax at 28% when you recognize that gain. The character of the gain does not change. Not all the gains from an event must be deferred. So you have $1 million sale, you really only want to invest $800,000 into the opportunity zone, you are able to do that. There's no tracing requirement for the cash. So if, for instance, you were to have an installment type sale where you're going to have to recognize that installment sale. So there's not duplicate deferrals allowed. No like-kind exchanges, no installment sales where you're deferring. So you have to elect out of installment sale treatment, recognize all of your gain from the upfront, but it's not bad because you invest in the opportunity zone, and so then you get that deferral that's attached to the opportunity zone. So let's take an installment sale. You may not get all the cash from the upfront. So if you have other sources of cash, you're allowed to use those other sources of cash to basically come up with your investment corpus. This does not apply to sales after 12/31/2026. After that, any deferrals that you have and any investments that you make into an opportunity zone, it doesn't matter. You're not eligible for this program. You must invest in the opportunity zone fund within 180 days. Now, you would think 180 days means 180 days, but no. So if you own, for instance, your IBM stock or your building, and you own that directly, and you have a date of sale, the date of sale starts, the 180 days starts right after your date of sale. However, if you own it within a partnership, for instance, so the partnership is who is selling, the partnership has options. The partnership can choose itself to defer and invest in an opportunity zone fund, or it can choose not to, in which case the partners then have 2 choices. They can either, if they have the information, look at the date of sale and use that to start their 180 days clicking, or you look at the last day of the partnership's tax year, which for most partnerships is 12/31. Now, if you wait to communicate to your partners until they get a K-1 in April, it's not going to work. You've not given them any opportunity to defer to meet the 180 days. So there's going to have to be a lot of communication within partnerships that are having a capital gain event to communicate to their partners, hey, this gain is coming to you, here's what the dates are, and there is no formal mechanism to do that. There's nothing in the regs that say that you have to do it this way, or file a form or anything like that. That just needs to be a part of your normal investment communication. REIT and dividends, capital gains dividends received. If the dividends are actually received, it's the date the dividends are received. If they're undistributed dividends, it's the last day of the REIT or WIC or REIT's tax year. And I mentioned before, there are no other deferrals allowed. That includes like-kind exchanges or installment gains. And as we'll talk about a little bit, a like-kind exchange into an opportunity zone partnership would not work anyway because you need to have purchased your interest for money, not for a contribution of property or services. And you'll kind of see on that chart that we had before, really at the end of the 10-year period, basis is equal to your capital gain deferral, which is equal to the amount that you invested in the qualified opportunity fund. They kind of all come together after that 10 years. One question that we had was, okay, well, what happens at the end of 10 years? Communities are really interested in this. Do we now have an exit of capital at the end of the 10-year mark because everybody needs to realize gains in order to get this elimination? And the answer is no. You actually have until 2047 to sell. So think about the gains that are going to be realized in that period. That is a long time. So you have the opportunity to completely eliminate the appreciation as long as you sell before 2047. Now, what happens if you choose to keep that property beyond then? Don't know. There's rampant rumor and speculation involved. Everything from, hey, you get a valuation, so you kind of cap what that gain is, to nothing. You don't get any benefit if you don't sell before then. Another unclear thing is what happens with depreciation recapture. We know that gains on exit, capital gains on exit are eliminated, but we don't know what happens to depreciation recapture. And then we also don't know what happens to interim gains. So you tend to have a fund of fund, and we'll kind of get to that discussion before between indirect and direct investments. And so the way that we're currently reading it is if you invest in an opportunity fund, that's your top, but the fund itself is selling partnership and stock interest, can they reinvest that within a certain period of time and be able to not trigger a gain event? Like, does that affect your holding? Don't know the answer to that completely. And we don't also know what is the difference between a operating distribution and a return of capital, and what happens if, for instance, you decide to refinance and re-leverage your investments. And that happens a lot with real estate plays. At a certain point, you do a debt finance distribution, or you refinance the debt that's on there and you get money out to your investors. We don't know what the answer is to that.
Okay, so now that we know a little bit more about opportunity zones, let's talk a little bit about the state tax implications. So the good news is Colorado does conform to federal law. That means that any gains that you defer, Colorado will also recognize that deferment. Any reduction of capital gains tax as a result of your deferment, Colorado will also recognize. Good thing of note is that it might also be able to use this, some of these deferrals and these reductions of taxes in conjunction with other Colorado programs, such as the Colorado Capital Gain Subtraction. One thing to note, for non-Colorado opportunity zone property, every state is handling this a little bit differently. Some states are conforming, some states are not, some are kind of meeting halfway. So it's just a good thing to note and keep in mind that if you are investing into a fund that does have property in other states, to just make sure you talk with your accountant and make sure that you're kind of keeping track of that.
And the states don't know what they're doing yet either, so.
Okay, so let's talk about the actual fund mechanism itself. So here we have a good diagram of like how this is going to kind of work. There's basically two methods in which you can invest into an opportunity zone, directly or indirectly. Directly is this arrow right down the middle. You invest into a qualified opportunity fund, and then that fund buys or purchases business property within an opportunity zone. That would be the direct method. The indirect method would be you investing into a qualified opportunity fund, which then buys a partnership stake in a qualified opportunity zone business or buy stock in a qualified opportunity zone corporation. Right now, we have a slide up here that has some of the more finer details between direct and indirect investments. We won't get into this too much, but it's just good to know that there is a difference in some of these test requirements between a direct and an indirect investment.
And this is in your handout, in your
Yes.
packet.
Okay, so the investment must be acquired after December 31st, 2017 in exchange for cash. Just cash. You cannot contribute land into your interest into a qualified opportunity fund. It has to be cash. It must be a qualified opportunity zone business, or it must be organized for the purpose of being a qualified opportunity zone business. And it must remain a qualified opportunity zone business for substantially all of the qualified opportunity fund's holding period. A trade or business in which substantially all of the tangible property owned or leased by the taxpayer is located in a qualified opportunity zone, and at least 50% of the income derived from active conduct, a substantial portion of intangible property used in the active conduct of business, and less than 5% unadjusted basis of the property is non-qualified financial property. Qualified opportunity zone business property is tangible property meeting the following requirements. It's acquired after December 31st, 2017. That's a key date that you're going to keep seeing. The original use commences with the opportunity fund, or the qualified opportunity fund has substantially improved the property. Now, what does substantially improved mean? We'll get into that a little bit later. Substantially all of the use of the property is within a qualified opportunity zone. So there are certain types of businesses that cannot be formed as a qualified opportunity zone business. SIN businesses. Now, what does that mean? Well, we had to look that up. A private or commercial golf course, a country club, massage parlor, a facility used for gambling. This last sentence right here, this last one is interesting to note. Any store in which the principal business is the sale of alcoholic beverages for consumption off premises. So that means liquor stores, but that doesn't necessarily exclude, breweries that have, restaurants attached to them. So qualified opportunity fund, it's basically just a vehicle, an investment vehicle between you, the investor, as Trinity was kind of using the analogy. You're the investor, here's the fund, and then here's the actual investment down here. There's a 90% requirement for determining whether or not these assets are being held within a qualified opportunity zone or not. We'll get into that a little bit more later. And there's a penalty imposed for noncompliance. Now, how does one certify themselves as an opportunity fund? Taxpayer completes Form 8996, and a draft of that is in your guys' handout. This completed form is attached to the taxpayer's federal tax return for the taxable year the capital event gain occurred in.
It's very easy to become a qualified opportunity fund. They have not made the bar very high. You basically file that form with the fund, so partnership or corporations, S-corps are included in that, tax return when that is due. So extensions included. So you have time to decide if you're going to meet those metrics. And one planning point that I would kind of put out there is if you had something that would otherwise considered to be a like-kind exchange, or you're trying to figure out where to park money, you've got 180 days to create a partnership, put the money in, and then you've got time to figure out where to invest that money. So if it all goes, nothing works out, you're in no worse place than if you hadn't tried that. So just as kind of an investment idea or a planning idea.
Okay, so here's that 90% requirement that I was referring to earlier. You must hold at least 90% of your assets in opportunity zone property. Determined by the average of percentage of opportunity zone property held on the last day of the first 6-month period of the fund's taxable year and the last day of the fund's taxable year. So that's kind of how they're determining, kind of keeping people true to make sure that they're properly investing in these funds and keeping all of that money in that community.
So, of course, there's always a got you. So what happens if you can't qualify with for that 90% requirement? Basically what they're saying is, let's say your assets are 85% qualified, so you have a 5% shortfall. that 5%, the monetary value of that 5% shortfall is multiplied by the underpayment rate. So currently that's 5%, and that becomes a monthly penalty that is taxed in a partnership realm to the partners, not to the partnership. If you're dealing with a corporation, then presumably it stays with the corporation that pays the penalty. Now, there's no penalty if it is shown that the failure is due to reasonable cause. Yeah, I don't know what reasonable cause is. One of the things that did come out of the proposed regs, because you kind of think of this concept, you've got 180 days to put money into a qualified fund. So everybody is rushing to get money into these funds, and then you have to meet this 90% test. But you got cash, and you got 6 months to deploy that cash. That's really not a reasonable time frame, and there was a lot of commentary around that. And so what the IRS said was, okay, yeah, we hear you. So for businesses that acquire, construct, or rehabilitate tangible property, basically what you're looking at is you have 31 months to deploy that capital. So you've got 2 years and 7 months to basically construct, rehabilitate your property, which is very important if you're going vertical on raw land or you've got a substantial building improvement that you're trying to do. You have to have a written plan that identifies how you're going to deploy, and there needs to be a written schedule consistent with costs to basically deploy that cash within the 31 months. Then there's a caveat that your assets must actually be utilized in a manner consistent with your written plan. How you're going to find this, again, not quite sure. The other thing that came out of the proposed regulations was what is substantial improvement. And there was a big fear that you were going to look at purchasing property, and you would have to basically exceed, and what the language is, you have to exceed your basis in that property. That makes a lot of deals not viable. And so what they carved out was the land is not included in the basis that you need to exceed. So in our example, you purchase property for $1 million, the land is valued at $200,000, the building is $800,000, so your building improvements must be $800,001. $1 exceeds. Regulations don't address the treatment of unimproved land. So we still don't know if you don't have an existing building and you have raw land, which if you see a lot of our investment zones, especially in the Powers Corridor and North Nevada, there's a lot of vacant land there. We're not sure how exactly that land is supposed to be treated. That's in regs still to be issued. We're expecting another tranche of proposed regs, hopefully before the end of the year. And I will reiterate that proposed regs are simply that. They're kind of an idea of what the IRS is thinking. When they issued the proposed regs, they had 48 pages before the actual regs, where the IRS kind of listed their rationale and their position and the reasons why, and a specific request for commentary from the investment community, tax community, about how to change or apply these in a manner that is consistent. So there's a lot of I don't know involved in this. And so this brings us back to the maze. We are also part of the maze.
Is there any opportunity zone benefit if I already own property in a designated opportunity zone?
No. One of the issues that we are having to work through is it is very specific that property needed to have been acquired after December 31st, 2017. So one of the things that I am still trying to work through is how do I get your property to be acquired after December 31st, 2017? Is there a sale that we can do? Is there a maneuvering that we can do? But that question has been asked a lot, and right now the answer from what we're getting is that is not a benefit. So
What if I double the value of it by building a building on it?
you're still stuck with property must have been acquired after December 31st, 2017. They've really kind of narrowed the window of what this looks like.
So if I had an existing partnership that then bought property after December 31 of 17, I could make that work
You could make that work. However, you have to go
for the new property.
for the new property, but however, kind of go back, you must have deferred and purchased your interest in that partnership after December 31st, 2017, and you had 180 days to have a capital gain deferral. So you have to make a lot of moving pieces work. So I'm getting that question a lot, and I'm trying to figure out how to get there.
So this one isn't simple either. Okay, next question. For opportunity zone investments that are a combined capital gain and non-gain investment, the two are treated differently. How/when will the non-capital gain part of the investment be taxed?
So the non-capital gain part of the investment, that would be taxed regularly. So whenever you have a recognition event, you sell in 11 years, at that point, whenever you have a sale, that would create the event for that to be taxed. So it's concurrent, it's just a different treatment with the qualified investment. Does that make sense?
Mm-hmm. Yeah. Okay, so two people had this same similar question. I realize gains in 2018 and make a qualifying investment in an opportunity fund. When I pay the tax on my gain in 2026 with full 15% step up in basis, do I pay what the tax rate was in 2018 or the tax rate in 2026?
I think you pay the tax rate in 2026. Your character remains the same. There is no distinction that your rate remains the same.
All right, so what do you think about rates changing between now and 2026 for capital gains?
Okay, crystal ball. I'd be a talking head on whatever media. Who knows? I mean, that's totally Congress.
Yeah, but fairly less likely. I don't see capital gains rates making a material change. Okay. Can I sell a property which I previously purchased through a like-kind exchange and put the capital gains into a qualified opportunity fund?
Yes.
Sure.
So you sell your property, you're done with your like-kind exchange, you recognize everything that you had, all the tax that you had deferred at that point, and then you still defer it because then you put it in an opportunity zone and then you defer.
Okay. Are annual valuations required for opportunity funds?
No. What they defaulted to was cost basis. So if you have applicable financial statements, so you're an entity that gets an audit, you use the values that are in there. If you don't have such financial statements, you're looking at the cost basis. So, whatever is reporting on your tax return.
Okay. Will opportunity zones have a big impact on Colorado Springs?
I think so. I think that there is definitely a benefit to be gained from it. I have heard and seen where there's an interest in outside money coming in. There are huge mutual funds that are being put together at the national level to invest in different opportunity zones. I can see places like the airport zone, different areas like that are ripe for commercial development and you need the capital to attract. I can totally see that being a benefit to us.
Okay, and so far the last question. All right, here's an example. I have a capital gain of $1 million. I invest said $1 million in opportunity zone land. I spend another $1 million on improvement. Hold the property for 10 years and sell. Assuming no depreciation taken, how is it taxed upon sale?
Well, first of all, depreciation, so when you pull the building on, depreciation is allowed or allowable, so you have to depreciate. You don't really have a choice as depreciation. The question then becomes, when I sell, the depreciation recapture, and we're talking real property, we don't have a definitive answer to it, but based on how the treatment is for the capital gain deferral on depreciation on, real property, I would say you would not pay any tax at all on the appreciation when you sell.
Yeah.
That's a lot of hedging.
Yeah, but it's a classic example, of
Right.
what you want to do with an opportunity zone. So, did I miss anybody's questions on that? Oh, yeah, one in the back. Yeah. Oops.
So the question was, as a general partner on an opportunity zone deal, does having a carried interest above 20% negate the eligibility for the opportunity zone?
So first of all, the person who has a carried interest, and carried interest typically means that you have some kind of a profits interest, that person would not qualify because you have to have contributed cash. You have to have purchased your interest for cash. Now, what it did say is you can get a partnership interest with special allocations. So does that mean that I bought my interest for $100? I have a special allocation of my capital, of my profits interest basically, and that whole thing then becomes qualified for the opportunity zone. I'm guessing I can maybe get there, but I do not know that for sure. But the language currently says partnership interest with a special allocation, which is right for that. Now, even if it doesn't qualify, remember you can have mixed use funds within an opportunity zone. So you can have people investing that didn't have the deferral and will not end up with the elimination of gain. And then you can have other investors that do have the deferral and will end up with that opportunity, all investing in the same place. So that's, that would still qualify as long as the underlying assets that the fund owns meet all of the tests.
So how will we know the answer to that question in the future? How does the law work to get us an answer?
We're hoping for proposed regs. We're supposed to get additional regs by the end of the year, and we're hoping that those are some of the things that will be clarified within that. This is ongoing discussions around how these regs are going to be applied. I had the regs a week ago. I read it, I'm like, okay, I get one thing out of it. Then you start applying certain facts and circumstances to it, and you're trying to navigate your way to a best answer. So we're hoping for more clarification in the future.
So not all answers come in regulations, because sometimes we just don't know.
Right.
The taxpayer takes a position, the IRS disagrees, it goes to court, and a court makes that decision, and that becomes precedent. So,
And usually with that timeline, we'll know about 10 years from now, by the time the benefit is expired. Although there is a legislation that's currently on the floor in Congress, I don't know if it's going to go anywhere, to make them permanent, to not have a hard stop on them, and to basically have opportunity zones in perpetuity, in which case then that 2026 hard date for a deferral is no longer relevant. But who knows how far that is going to go.
how do we as a CPA firm add value to you? And, we look at it as a philosophical question, why do we exist? And there's probably many reasons to that, but the two that would strike me right away, who's got the remote, Trini? Do I? My job. Yeah, I'd say there's two main things that our clients ask of us. Number one, on the left, is to relieve their stress. Not our stress, relieve your stress. And two, make sure there's an extra buck or two in your pocket. So knowing that's part of our mission with respect to you, when you go home tonight and your spouse says to you, so how did the seminar go? We hope you don't answer, I'm still confused, but at a higher level. I hope you can say, I think I got it. So I think I'm less stressed. I'm hoping that I might have figured out if we can save a buck or two. But just to be safe, I'm going to call later. So, but anyway, thank you again for being here, and hopefully we all see you next door.